Welcome to Analyzing Finance with Nick. We've done the iceberg of finance, economics, and wealth management, and now we're going to do our next iceberg, which is the iceberg of options and volatility. Why are we doing this one? One, I think this is something a lot of people don't know that much about. I have a pretty strong expertise. I worked at one of the largest options market making hedge funds for 3 years as a research analyst. And I do a lot of options related work for my clients at my current wealth management firm that I am a partner at. So I figured I would kind of share my expertise and kind of go down the layers of the iceberg in the world of the derivatives market. As there's nothing on here as investment advice. Please do your own investment research or retain an investment advisor. I'm not going to answer any specific trading related questions in these videos. So if you have those kind of questions, instead of the comments, I recommend just contacting me directly, either through email or my consultation form. European versus American are two conventional types of options. There are also more exotic types of options, which I'll talk about later in this iceberg. And I also have a whole video I did about exotic options several years ago. But you have American option is an option that you can expire at any point, you can exercise at any single time within the length of the contract. Say it's a 90-day contract, you can exercise it, which means you swap the option for the and take delivery on the underlying security at any time you want. You usually have no incentive to do this before expiration, barring special situations, because why would you have to add the additional cash you need to put up to buy those shares if you'll get the same kind of upside by just owning the option? But the American options let you be able to exercise early if you want to. Whereas a European option is an option that you only are allowed to exercise on the day of expiration. And then there's options that kind of are in between where you have a fixed band of time, and that's called a Bermudan option. And then there's Asian options, which are based on the average price of the stock over a given period of time. Yeah, there's a lot of other types of structures, but European and American options are typical. And most of the ones that you're typically going to interact with, probably in a brokerage account, are either one of those two. Now we're going to move on to level 5, and it's about Citadel. Next, we're going to talk about gamma squeezes. A gamma squeeze, when you have like a surprise upward move in an asset class, usually due to a short squeeze, but it could be a news shock or something else, where you have a lot of people who are short gamma, which basically means they're not expecting like it to move beyond a certain point. Usually they are people who are selling options that are out of the money. All of a sudden have to become forced buyers to either delta hedge their positions if they're market makers, or to cover their losses if they're taking a speculative selling option bet. And this increased all of a sudden need to either buy or sell in line with the direction of the gamma shock move creates a gamma squeeze, which makes what would be a smaller move in underlying a much bigger move due to all the short gamma participants having to cover their positions in a very quick manner. Now we're going to talk about is options strategies. The first one of these option strategies I'm going to talk about are the most notable ones, which are straddles and strangles. A straddle is basically when you buy a put and a call at the same strike. And you do this because you expect volatility to be higher than what is implied. So say, for example, there's a stock at $100. The put costs 5. The call costs 5. If you buy them both, you'll make money if the stock moves more than plus or minus $10 each way. And if it moves less than that, you will take a loss. And that is a straddle. You could sell a straddle if you expect less variance, where you make the most money if it's at 0, and you make progressively less money until it gets to the strike, plus the premium points, and then you start losing and you move greater than the combined premium of the positions you sold. A strangle is similar, except instead of converging at a single point by buying the options at the same strike, you buy them at a band. So instead of, say, for example, buying both stock strikes at 100, you buy the 95 put and the 105 call. and you make a fixed amount of money as long as, you lose a fixed amount of money as long as the option is stuck between 95 and 105. But any amount below 95 or greater than 105, your position starts to progress in the money and soon makes an outright profit depending on the premiums you paid. And selling a strangle is the reverse. You get a fixed locked in return at those points, but if it moves away from one of the strikes to the other, you start to lose. It's just a wider version. Instead of having converge at one point, you converges at a range of prices. These are the most common strategies apart from vertical spreads, which a vertical spread is simply when you buy a put or a call at one price closer to the money, and you sell another put or call out of the money. So you collect a fixed amount if it moves through your range. So, and say for example, I buy a stock, there's a stock at 100, and I buy a call at a 105 and I sell a call at 115. And so my maximum I'm going to make is 10 because selling the call basically calls out any of my gains above 115. But at the same time, by selling that call, if I bought the stock, the call by itself, it'd be $5 to say for this example. So I have more upside, but I need it to move up a lot more to make a profit. Whereas I buy the spread may only cost $2 because I'm selling an out of the money against it. So I'm risking $2 to make 10. And so a lot of these spreads offer more attractive risk reward ratios than just buying the option outright, especially when volatility is high. By doing vertical spreads, you're making more of a pure directional bet and less of an implied volatility bet, because especially if skew is high, because a lot of the implied volatilities from selling the call out compensate for the volatility you are buying from closer to the money call. And it works the same with puts too. So those are vertical spreads. And then there are time spreads where you buy an option at the same strike, but at two different expirations. And the reason you do this, or you buy at one and sell at the other, and the reason you do this is you expect an event to happen in a certain time. And so if you expect the event to happen after one strike, but before the next, you can sell the front month and buy the later month, which basically you can have the upside move or the increased volatility expectation of the event at a lower price because you can sell the front month. If you're confident, for example, that you know that this event will not happen in this point, and if it's too well telegraphed, the market's going to price this in. But there are certain things where if you can have a good idea of the timing of it, that it would make sense to have a time spread. Then there are also diagonal spreads, which are a time spread and a vertical spread at the same time. You're trading a different strike, a different part of the term structure. Those are called diagonal spreads. And then there's some collars, which are used to lock in certain gains. It's where and usually these are done with a stock to protect existing gains, but you could sometimes do it without them, and you can kind of get similar to a synthetic bond type return where you basically buy a put and you sell a call a similar distance out of the money, and you want this to be close to as break even as possible. You buy a call and sell a put, which is a risk reversal. It's like a synthetic of owning the equity itself, but maybe possibly a cheaper entry point, but you have the same risk profile. So if the stock moves down more a certain price, you have the same downside as owning the stock. And if it moves up beyond a certain strike, you have the same payout as owning a stock. But if you think the stock's going to do nothing, you don't waste your capital holding this underlying. So that's what a risk reversal is. And then the last one I'm going to talk about next, I'm going to be talking about some more advanced option strategies. One is a butterfly, which is betting on a neutral movement of the stock, kind of like selling a straddle, but a little bit safer. It's when you're really trying to target a very specific price. And the way you set this up is you buy one lower strike out of the money call, you sell two at the money calls, and you buy one higher out of the money calls. You make money if it stays near the mid price where you sold the calls. That's where you make the most money. You lose if the stock moves too much in either direction, and your risk is limited because you are buying the lower strikes and you're using the premium sold to finance the position. So it does create a defined risk profile, and it creates a shape that's kind of, if you really try with your best imagination, kind of looks like a butterfly. And I'll show the image. Where the stock is now, you can use it slightly higher prices with calls or lower prices with puts. A condor is similar to a butterfly. And what this does is that you buy a lower strike call, you sell a slightly higher strike call, and you sell another slightly higher strike call, and you buy another higher strike call, but you do it more in a range. And so it's kind of like a strangle versus a straddle in this sense. So it creates a wider hitbox than a butterfly, but it has lower max profit potential than a butterfly. So that's kind of the trade-off. And it's a similar trade-off you're getting with a strangle versus a straddle. The next really thing I'm going to talk about is iron butterflies. What makes an iron butterfly iron? Like, that's a question that I think that a lot of people have. An iron version is a synthetic version of the regular butterfly strategy. But instead of using all calls and puts, you use a combination of puts and calls, and you can use put-call parity to create the synthetic alternatives. And that's what an iron condor as well. And put-call parity, which I should have a term here on the visual, but I do not, but I'm going to explain it here, is the idea that there's a formula that you can use to basically create any sort of synthetic version of any of the four types of elements in the derivative or underlying with other pieces. And so it's like the formula is like put plus stock equals call plus bond. And based on that, you can derive any of the four with a combination of the other three. So if I wanted a synthetic call, what I would do is I would own the put, I would own the stock, and I'd be short the bond. Whereas if I want a synthetic put, I would be short the stock, long the bond, and long the call. And you can do this and create the strategy and the directional risk reward setup you want without necessarily doing the pure form of it. And the reason why this is important, because it means that there should be some sort of, they should all basically trade in a certain way that this cannot be arbitrage. And if it can, it means there's a way to make risk-free profits. So like if a put is more expensive than buying the call and the bond while shorting the stock, then you would just have one on one position. You would hedge these against each other and lock in an arbitrage. So that is put call parity. And based on that, it should be what help you determine what the appropriate price is to pay for the option relative to the other options you have in terms of trading. If I put that in a good way. Sometimes it's kind of hard to explain these kind of things you know intuitively, but can't really put into words. So that's going to conclude level 5. The next 3 are going to get a little bit even more crazy, but I look forward to continuing this journey with you.